investors, welcome to 2019 and Shark Investments, where I identify quality stocks for your investment consideration. Now let's face it, we've had it rather easy during this long bull market. You could invest in almost anything and expect to make money at it. But late in 2018, that all changed. Volatility went crazy. The Dow had its worst December since 1931, and the bear entered the investing arena. Okay, got kicked out again right after Christmas, but where this is going to play out in 2019 is going to make it interesting. People started asking a lot of questions. Do I buy? Do I sell? Do I hold? Where do I go or reallocate? Fortunately, we've had some reassuring influencers out there like Warren Buffett, who famously said, "Be fearful when others are greedy, and greedy when others are fearful." So for those of us who can keep our cool and invest wisely, this has the potential to be a very good time. It's also a great time to revisit quality stocks. And I'd like to help you by providing a weekly list of stocks that I consider to be qualified to be called quality stocks. Now this is my introductory session. What I'm going to do is explain where I get my data, how I conduct my analysis, and the 6 criteria that I use to call a company a quality stock. Now, because we are going to be talking about financial information and people will be making decisions, I need to put a disclaimer out there. To the best of my knowledge, this information that I'm going to give you is complete and accurate, unbiased. However, I can take no responsibility for any of the decisions that you make and how you decide to use this for your investments. All right, to get started, the first thing we want to do is find an unbiased source for historic stock data. I use the Value Line Investment Survey. Value Line accepts no advertising dollars. Companies cannot buy their way onto the survey. There are about 1,700 companies in the universe that I subscribe to, and each week Value Line will conduct an analysis of about 130 of those companies. There are 13 issues, and then they go back and reanalyze the companies again. Value Line also provides a lot of very valuable proprietary analysis in each of those issues. I am not going to discuss the proprietary analysis. We're just going to look at the historic data. However, I urge those of you out there that are serious about investing to go to valueline.com, look at the various products that they offer, and see if there's something there that you want to subscribe to. Next, we need to identify 3 commonly reported gap-derived elements that we can use to assess the financial strength, the profitability, and the concern that the companies have for shareholders. So we're going to use the historic cash flow per share, earnings per share, and dividends per share. Now we're going to take a long-term performance view, 17 years. Why 17 years? Because that's how far back Value Line looks at the companies that they analyze. No more than 17 years. And we're going to set 2 tough but very achievable standards. First, 17 years of annual increases for cash flow per share, earnings per share, and dividends per share. However, we will allow 1 negative or flat year for each of those 3 criteria. Here's what this looks like. A CF0 is a cash flow 0. And that means that that company has had increasing cash flow per share per year for 17 years. A CF1 is 17 years of increasing cash flow per share with 1 negative or flat year. E0, earnings per share, increasing for 17 years. E1, 17 years of increasing earnings per share with one negative or flat year. A div 0 means increasing dividends per share for 17 years, and a div 1 means 17 years of increasing dividends per share with one flat year. Notice there's no negative years allowed in the dividends. All right, now the best way to understand this is to go look at some examples, so let's go do that right now. So I'm sure that once we've gone through a few of these examples, this is going to become very clear. I'm going to start out right over here in the left-hand column. That's giving you the issue number that this data is coming from. Next, we'll have the name of the company that we're looking at with its ticker symbol. And then the dividend yield, in this case 3.8%. And you see that that's filled in gold. That's telling us that that is greater than the 2.5%, that is the Dow Jones average dividend yield. And then the valid date for this report. All right, next we're going to have rows that give us the cash flow per share, and then another row that does the year-to-year change, the earnings per share with its year-to-year change, the dividends per share with their year-to-year change. Across the top, we see the years that this data is reporting on. And out here to the right, we've got 2018 and 2019. Those are in bold, and that's telling us that those are estimates. The books haven't closed on 2018. When the books close, they become unbold. Now, part of the value of using Excel for this is it quickly does the math and shows us when we have negative years. You can see with this red numbers in parentheses. And then if we have a flat year, it'll fill in yellow. The other thing that we can do with Excel is it'll count up all those negatives and flat years, and then it will tell me very quickly that in the case of Flour Foods, we are not qualified for cash flow because we had too many disqualifying events. Remember, you can either have a CF0 or a CF1. Anything over that is going to make you not qualified. Earnings per share is not qualified with, again, too many disqualifying events. But Flour Foods is a div 0, meaning it had 17 years of increasing dividends per share. No flat years. You can see there's no yellow fills in here. All right, next we're going to go to the Hershey Company. Love the chocolate. Dividend yield at 2.8%, filled with gold because it's greater than the Dow Jones 2.5. We'll go right over to the right hand side. You'll see they are not qualified by cash flow, not qualified for earnings, but they are a div 1. You very quickly see here the yellow fill telling you that from 2008 to 2009 they had a flat year. Lancaster Colony. Their dividend yield of 1.6 does not fill with gold because it is below the 2.5. Go over here to the right hand side and we see that they are not qualified for cash flow per share, not qualified for earnings per share, but they are a div 0. McCormick and Company, the spice people, their dividend yield is 1.6. Again, it's not filled. What's interesting about McCormick though is when you go over here to the right, you see that they are qualified in all three major elements. They are a CF0, an E0, and a div 0. So that means that for 17 years they have had increasing cash flow per share, earnings per share, and dividends per share. Certainly, McCormick should be given some special consideration. J.M. Smucker, peanut butter, jelly, those kind of things, they're 3.4%, fills with gold. And you go over and you see they are a div 0. USANA Health Services. Now this is going to happen sometimes. They don't offer any dividends. It should be a 0 or nil. And you can see the nice big yellow bar across here telling us that they do not offer dividends. But they are qualified as an E1 and a cash flow 1. Sysco Corporation, I'm sure you've seen their trucks out on the road. They're at 2.1% yield. They are a Div 0. Now draw your attention to the purple fill under Sysco. That means that I used to own stock in Sysco. United Natural Foods, they are nil. You see the big yellow bar here. No dividends offered, but they are qualified as a cash flow 1. Brown and Forman, we're in the beverage world now. Brown and Forman is a Div 0. The Coca-Cola Company, it's green because I own Coca-Cola stock. Coca-Cola is one of the first companies that I bought shares in when I started this new analysis technique, and I've been very pleased with them over the years. They're at 3.5% filled with gold there. They are a Div 0. Right behind them is Pepsi Company at 3.4% yield, also a Div 0. Some people like Coke, some like Pepsi. You might want to invest in both. Universal Corporation, that's a tobacco company. They're at 4.5%. They are a Div 0. Now I'll draw your attention here to this 12. That's telling me that there were 12 companies in addition or issue 10 that met my qualification standards. There are about 130 companies in each edition and only 12 got qualified. Sometimes that number is a lot less. So the next category that you're going to see is previously qualified. These are companies that were qualified, but during the recycling of the data, remember there are 13 editions, so at the end of that 13-week period we start over with edition 1, go back through the companies. Things change, of course, so companies may fall off the list. When they do, I'm going to put a red fill out here in the cells so that you can see that they were previously qualified as a div, but not any longer. And then we will also have one or two companies that are not qualified names of interest. So these would be companies that are either big companies or common names, and you might wonder, well, wait a minute, why didn't so-and-so make this list? Now, in the case of General Mills, they're actually pretty interesting to look at because, well, they have a dividend yield of 4.6, so that's pretty good. And if you look over here, you see they're not qualified on cash flow, earnings, or dividends. But let's go over here now and look at these dividends, because you see that the flat years are right up in these early years of analysis. So 2002, 3, and then 2003 to 4, they had their flat years. Well, a year from now, when we start at 2003 and we go to 2020, one of these is going to go away. So that could make General Mills qualified as a Div 1. So we're going to keep an eye on these folks. All right, then I put just little reminders down here. Gold fill cells mean that that dividend yield was greater than the Dow Jones average yield, which is 2.5 right now. The purple means that I previously owned it, and the green means that I currently own it. Now, what I really hope will happen is that after you've watched this video and you see the analysis that I've done, that you'll go into the comments section and you'll leave some notes about the companies that I've talked about. I'm sure that a lot of you own stock in some of these, or that you have information in some of these companies, and I think that it would be very informative if we shared that information with each other. Goods, bads, whys, why nots, what you've heard, what you've seen, what you've read. We all have multiple sources that we're using. This could be a good place to share that information. We'll keep it good and professional and have a fun exchange of that data. Of course, the other thing that I'll ask you to do is always tell me what you liked or didn't like about each presentation so that I can continuously improve my videos and what I'm sharing with you. Now, the other thing that I want to emphasize is that just because a company makes our list does not mean that it's an automatic investment. What it means is that that company is worth going and taking a deeper dive into, learning more about what they're doing, where they fit in with the current economic situation, what do their growth prospects look like. Wow, that was a hard one to say. How's their financial strength? Have they had big changes in their board? I mean, there's all kinds of information out there that we want to know before we make an investment in a company. Now, this is a good time for me to tell everybody that Value Line does a lot of this analysis for us and provides it in the Value Line Investment Survey and many of their other focused products. So again, I encourage everybody who's listening to go look at the Value Line products at valueline.com, get familiar with what they offer, and subscribe to those services that make the most sense for you.